Hello everyone, and welcome to the second podcast for CVC Credit Partners European Opportunities. In the first video, I gave an introduction to who we are, what we do, and our track record. Today, I want to explain in some more detail what leveraged loans are and why we think this asset class is currently attractive. First of all, loans provide a contractual income for investors. In a world where income is difficult to find, European leveraged loans provide a compelling risk-adjusted return. At the end of June 2021, the running yield, another word for income, on the Credit Suisse European Leveraged Loan Index was around 3.75%. To compare this to other fixed income products, on the same date, the yield on the European High Yield Index was 3.12%. The yield on the European Investment Grade Index is just around 0% now, and most European sovereign bonds now have negative yields, which means you're guaranteed to lose money on these if you hold them to maturity. Investors can also get income on dividend-paying stocks or real estate, but the price of these investments could move up or down considerably. For example, the S&P 500 is now trading at the price-earnings ratio of around 29, while the average over the last 30 years was just below 20. At the same time, according to the Office for National Statistics, the median house price to median earnings in the UK has gone from 5.1 times in the early 2000s to 7.8 times at the end of 2020. The price of commercial property has also increased considerably, and we have seen a number of property funds putting up gates so investors couldn't redeem, first on the back of Brexit and then again on the back of COVID. Real estate is inherently an illiquid asset, and that's something investors need to take into account when investing in such strategies. Of course, with leveraged loans, the main risk is underlying default risk for the companies we invest in, i.e., the risk that the borrower won't be able to meet their repayment obligations. Over the last few years, despite the lack of growth in Europe, defaults have been fairly benign. During the financial crisis, defaults peaked at around 10% in Europe. However, during last year's pandemic, default rates in the Credit Suisse Western European Leveraged Loan Index peaked at 1.5%, and the average default rate over the last 5 years has been around 0.9%. If you just look at the last 12 months, the default rate was 0.5%, with an average recovery rate of 72.5%, resulting in a loss rate of 0.1%. This is very small compared to the 3.75% income that the index is paying now. It's well known that fixed rate bonds don't do well in an inflationary environment. The latest UK RPI data for July suggests inflation is running at around 3.9%, well above the 2% target for the Bank of England, and we're seeing similar data in the US and the Eurozone. Central banks worldwide seem to suggest that this inflationary pressure is temporary as a result of restocking and supply chain issues as economies reopen post the global pandemic. When inflation picks up, central banks are expected to hike base rates and fixed rate bonds will lose in value. The Bank of England's base rate is currently 0.10%, but financial markets are currently pricing in that we'll see the first rate hike sometime next year. In the US, the Fed has guided for 2 interest rate hikes in 2023, but again, some people are predicting that these rate hikes may come much sooner than 2023. As a result of the high inflation data and views on central bank actions, many investors are looking at alternatives to fixed rate bonds to inflation-proof their portfolio while still getting a regular income. We believe that leveraged loans provide this alternative, as loans have a coupon that is linked to LIBOR or an alternative benchmark. So the coupon effectively gets reset every 3 months, which means that investors don't really take any underlying rate risk, as the coupon will move in step with any changes to interest rates. In the first half of the year, we have seen both retail and institutional investors in the US move out of fixed rate bonds and into floating rate loans as a result of the debate around inflation. Another advantage of loans is that loans tend to be senior secured in the capital structure. This effectively means that loans rank the highest in the capital structure in terms of payout. If a company were to run into trouble, the senior and secured debt will be repaid first, then the more junior unsecured debt, and then finally the equity. When we compare the Credit Suisse Loan Index with the Credit Suisse High Yield Index, the Credit Suisse Loan Index consists of 99% senior secured loans, while the Credit Suisse High Yield Index consists of 41% senior secured bonds, with the remainder unsecured. A lot of bonds in the High Yield Index are fallen angels. This means these companies used to be investment grade companies that got away with extremely loose covenants in their bond prospectus. Even stronger rated high yield companies get away with very little covenants. Covenants basically provide credit investors with downside protection as it limits what a company can and cannot do. A good example of why the position in the capital structure is important is Carnival, the cruise ship operator. Before the pandemic, this company was an A- company, one of the highest credit ratings for corporates, and very few bond investors worried about the investor protection when they invested in these bonds. No one could of course have predicted this global pandemic, but today Carnival is rated single B with a negative outlook, a full 8 notches lower than A-, and only 2 notches above triple C+. The company burned just over $10 billion of cash in 2020 as a result of the global pandemic that brought the cruise industry to a halt pretty much overnight. The company funded this cash burn in the capital markets by offering a large part of its vessels as collateral to new lenders. This means that the existing bondholders were effectively primed. A big part of the collateral they thought they had was effectively given away as collateral to new lenders. If the company still ends up defaulting, these new lenders would look at very high recovery rates, given they have security over these vessels. The initial unsecured lenders, however, would see very low recovery rates, as most of the assets the company owns has been given away as collateral to new investors. This means a default doesn't really mean the same thing for all credit investors. To put some context around this, the average recovery rate on the Credit Suisse Loan Index over the last 12 months was 72.5%, while the average recovery on the Credit Suisse High Yield Index was 54.9%. If we combine these numbers with the default rates over the last 12 months on the Credit Suisse Loan Index of 0.5% and the Credit Suisse High Yield Index of 1.4%, you can easily see that the average loss rates for the loan index was 0.1%, while the average loss rates for the bond index was 0.8%. If you compare these historic lower loss rates with the higher income on the index and the better inflation protection, you can see why we are constructive on leveraged loans as an asset class at this point in the cycle. CVC Credit Partners European Opportunities is one of the only investment trusts that invests in leveraged loans, and one of the only opportunities for smaller investors to access the asset class. Given the listed nature of the investment trust, a lot of our investors would like to know how the asset class performs compared to general equity markets. Over time, the European leveraged loan market has proven to be a fairly resilient asset class with limited correlation with equities. In fact, loans are actually pretty boring compared to equities, despite what you may sometimes read in the popular press. This low correlation with equities goes back towards the point I mentioned earlier on where loans sit in the capital structure. Given the senior secured nature of loans, the impact of a big macro shock on the price of loans should be lower than on equities. If there is an external event such as a global pandemic, concerns around global growth, or any other macro shocks, investors will reassess the probability of default in the market and the recovery rates, which means the average price of loans will be somewhat below par, depending on the severity of the recession. We would only expect default rates to increase materially from here if macroeconomic conditions are a lot worse than what financial markets are expecting now. With lower growth expectations, equities could sell off materially, especially given the high valuations we're seeing in markets right now. A good example of this is what happened in Q4 2018, when financial markets became concerned about the impact of the potential trade war between China and the US, while growth was already slowing down. The FTSE 100 was down 9.4% from the 1st of September 2018 to the 31st of December 2018, while the Credit Suisse Western European Leveraged Loan Index was down 1.2% over the same time period. Finally, I would also like to point out that the European leveraged loan market is a rapidly growing and liquid market. The total size of the market is now around 350 billion euros, up from around 160 billion at the end of 2016. This means that in less than 5 years, the market has more than doubled, and we're seeing more and more institutional investors looking at the European loan market as a genuine alternative to the European high yield market. With the growth of the market and an increasing number of institutional investors involved, liquidity in the secondary market has improved a lot over the last few years. Even in the second half of March 2020, when financial markets were in freefall, we could still trade our positions. We have a quarterly tender mechanism where investors who have been on the share register for 6 months or longer can sell their shares back to us at NAV minus 1%. This ensures that discount to NAV for the shares of the investment trust typically remains fairly low. We can offer this quarterly tender to our investors as we invest in large liquid loans, and we can easily reduce or add to our positions, which means at any time we can issue more shares if investors are interested, or we can buy back shares from investors should investors want to redeem. I previously mentioned some of the UK commercial property funds that had to stop investors from redeeming in periods of volatility, as their underlying investments are large buildings and they can't sell these on a daily basis. We can increase or reduce our positions on a daily basis by buying or selling loans in the secondary market, and the quarterly tender mechanism has never really caused us an issue, even in the midst of the pandemic. I would like to finish off by summarizing why we believe loans are attractive in the current market. First of all, the income generated by European loans is attractive versus other options, with historically limited loss rates from defaults. Secondly, loans are one of the few asset classes that should do well if central banks start changing their ultra-loose monetary policy. Thirdly, the senior secured nature and the capital structure provide investors with downside protection, and historically, loans have outperformed in periods of volatility. Finally, this is a liquid asset class which allows us to risk manage our positions and accommodate investors should they want to increase or reduce their exposure. You can find a lot more information about the investment trust on our website, ccpeol.com. Thanks for listening.